Hello everybody, this is Ted Bauman here, editor of the Bauman Letter, with your Bauman Daily Friday video. Before I start on today's topic, which is a follow-on from last week, I have a couple of housekeeping issues I want to follow up on. Partly it's some responses to some of the comments I got. Somebody called me a Debbie Downer. Somebody wanted to know when I was going to start being optimistic and positive. They want to know if I'm shorting the market. Folks, it doesn't make me happy to be reporting on the things that I see, but that's what I do. I call it like it is, and right now, as I've explained before in videos, I see not just a short-term problem in the stock market, but big structural problems in the United States economy. I'm not a cheerleader for anybody. Basically, my core interest is in helping people to achieve independence financially, but also in terms of their thinking. And one of the problems that we have, particularly in the stock market and with a lot of analysis, is that people decide that they're going to design their way of presenting themselves as a stock analyst around a certain message, and then they stick with that no matter what. That's not helping you. That's just basically helping them to build their brand. I'm not trying to build a negative brand. I'm simply trying to call it as I see it. And as an economist, as I said, as an historian, as somebody who follows politics, and most of all, as somebody who really cares about what happens to everybody in the economy, not just investors, but also workers. Yes, I am very concerned about what happens in the United States economy. And until things start to improve, until we start to see people earning decent wages and able to spend decent money to support themselves and their families, I don't see how we can have a strong economy. That's it. That's my background. That's how I see the world. You know, if that makes me a Debbie Downer, so be it. As I said, my goal is to tell it as I see it. Second thing is, the reason I'm covering this particular topic, one person asked, how does this help you make money? Well, one thing that it can do is to help you understand how the overall system works, the fiscal system, the monetary system in the United States, but more importantly, to understand that it's the result of choices. It's not just a natural thing that has always been there, and it's not just the only way it can be. Now, that may not help you to make money in the short term, although I think it can if you understand particularly why there is little danger of consumer inflation coming up. But the critical thing is, you know, the system that we operate in is one that was designed not for us, not for those of us who are trying to make money as individual investors, but it's designed around the interests really of the very wealthy and powerful in this country. And to be able to survive and make money in it, you really need to understand how that works and to understand how it has been designed not for you, but for others. You can make money in it. My Bauman Letter does. And no, I'm not going to show all of my positions because it's a paid newsletter. And those of you who are asking me to show them, nope. If you want, subscribe. Come on. But I'm not going to do that. Bottom line is, I think that this is critical information that people need to understand in order to make informed decisions, not just about their investments, but also about politics and about the kind of choices that we make going forward. And no, it's not about Republican versus Democrat. It's not about Trump versus Biden. In many ways, it's about everybody versus those who kind of design and run the system and allow us to participate on their terms. Now, in this video, I'm going to talk about what I spoke about last week, what I introduced, the idea of another way of financing government spending. And no, it has nothing to do with socialism. It's not fascism. It's perfectly compatible with capitalism. In fact, it is simply a different way of looking at how the government as a spending entity can operate, how the Federal Reserve operates, and why the current system acts as a brake on our ability to adopt policies that could actually help us. And in that respect, the person who says I'm anti-Keynesian, boy, are you wrong. You got it exactly opposite wrong. And I think that's an important thing because it leads me to the last bit of housekeeping. People sometimes making assumptions about things is just the wrong thing to do. Let's start with this. People have asked me, why do I have a book with a swastika on it in my background? This is one of the most important books of 20th century history. It's by William R. Shirer. L. Shirer. It is a book called The Rise and Fall of the Third Reich. It is one of the most important things to understand and to read if you want to understand how things as horrific as fascism can emerge in societies. No, I'm not going to take it off my bookshelf. Those of you who suggest that I should simply because it has a swastika on it, find another channel to watch, folks. I'm not going with that kind of PC stuff. The fact that I think that a lot of people these days want to edit and censor anything that they see that shocks them or makes them feel bad. I just think that that's a bad way to operate. I read this book because I want to understand what happened so it'll never happen again, and I recommend everybody should read it. It is one of the great works of 20th century history. Now let's move on to my video for today. Last week I spoke about the fundamental problem that an economy faces in a recession. Here's the chart I showed. This shows the situation during the Great Depression, and it shows that the potential output of the economy was the solid line rising upward. But what happened was that because of the collapse of the banking system and the stock market in 1929, the economy was producing below its output. That led to a recessionary gap, and the question was, how do you fill that gap? Now, the Roosevelt policy was essentially to spend money to fill that gap. The government stepped in because individual private actors, households, businesses, etc., were not spending the money to bring the economy back up due to something called market failure. I'm not going to go into detail about that, but it's something you should understand. If you want to, look it up, Google it. Basically, what it means is that under normal conditions, it is perfectly possible for plenty of people to want to buy and sell things, and people to want to work, and people to want to hire them, but it doesn't happen because the signals get messed up. Keynes's view was that in that situation, the government steps in to spend. So that is the background for this. And the Keynesian view essentially says that there's a finite limit to the current productive capacity of the economy. It grows over time as investment happens, as productivity happens, as more people enter the workforce. But when we fall below it, the best thing to do is to get the government to spend money and use it to boost the economy back up to its potential level so we don't have to suffer through depressions and recessions. The problem is that the conventional wisdom that is taught to us by economics professors and that is trotted out constantly by the most wealthy people in the society who don't want to pay taxes, is that the government can only spend money if it borrows it from the economy, and it can only do that through taxing or through raising debt. Both of those things crimp future or current expenditure, crimp future expenditure, so it slows down the economy. So essentially, the notion that we have to borrow money to pay for government spending is fundamentally anti-Keynesian. It's something that is designed, in a sense, ideologically to prevent the government from doing exactly that. It's designed to preserve the wealth of people who don't want to be taxed. That's not, again, it's not for me, that's not a right or left issue, it's just a fact. It's clear that the Keynesian approach to bringing the economy up during a depressive period can work, but it depends on something else that is not normally discussed, and that's what I'm going to discuss today. Now, let's look at the issues that I talked about last week. Here's a chart that shows how the government traditionally operates. It taxes people, it then uses that money to spend. It borrows in return for Treasury bonds, either to the domestic economy or to the foreign sector, and in that way it funds its operations. Now, the second chart, the second picture here, shows that in the current situation, what we're getting is, in addition to those things, we're getting a situation where the Federal Reserve is essentially creating money out of thin air and what we call monetizing the debt. In other words, when the government issues new treasuries, they go through the motions of selling them to dealer banks, i.e. to make it look like they're actually just selling them into the private sector, but then the Federal Reserve immediately buys those treasuries from the dealer banks and then puts them on its balance sheet. Now, the idea behind doing that is that the Federal Reserve is raising its balance sheet, it's buying treasuries with the idea that it's someday going to pay them off. We started doing that in 2009, and to date, the Federal Reserve has not been able to reduce its balance sheet. In fact, it has dramatically increased, as this chart shows. Now, why hasn't it been able to do that? Well, remember something called the taper tantrum that happened in the mid-2010s? That was when stock prices fell dramatically when the Fed said it was going to start reducing its balance sheet and ending QE. So when that happened and the Fed backed off, that sent a signal to pretty much everybody, all investors, that the Fed had adopted a third unwritten mandate, in addition to keeping prices stable and keeping reasonable employment levels, that it was going to prop up the value of the stock market. Now, how do we know that? We know that because the Fed has backed off every time the stocks have begun to fall when the Fed has said, well, we're going to start reining back in. That tells me that the Fed is more worried about the reaction of the stock market than it is about its other mandates. I'm going to explain why we don't have inflation, but remember, keeping stock prices up is not part of the Fed's mandate. Now, the Fed hasn't reduced its balance sheet. What happens is every time treasuries come due, the Treasury Department issues new ones. We go through the whole charade again. They sell those to dealer banks. The Fed buys them from the dealer banks and redeems the original ones. Now, that's essentially what the QE system does in terms of government financing. Now, remember, most of QE does not go to the actual spending sector, right? It goes into the form of bank reserves, which allow banks, thanks to fractional reserve banking practices, to lend more money if they choose to. But because there's so little demand in the economy, they don't typically do that. Instead, those things end up supporting other kinds of speculative activities. We can talk about the mechanics of that on another day, but the bottom line is that one of the critical points that I've been making is that all this QE doesn't go to Main Street, it goes to Wall Street, where Wall Street gets to decide how to use it. And it does that because the Fed has chosen to monetize government debt. There is an alternative. Let's talk about it. Some of you in the comments identified it. It's called modern monetary theory, or MMT. Now, MMT is basically saying, let's drop the pretense of quantitative easing. Forget about the notion of the government issuing treasuries and having somebody else buy them in the form of debt and the government notionally having to pay them off. We never pay them off anyway, so why not just dispense with all of that and have the government just print the money that it needs to spend in the economy? Why don't we do that? It's really no different than QE. It just does away with the charade that we are going through the banking system in order to get exactly the same result. Now, here is a picture that shows what the economy or the system would look like in MMT environment. And essentially, the idea is that the government would spend money and it would tax, but it would not issue any lending, it would not issue treasuries, it would not work through dealer banks. The Federal Reserve would not have to print money in order to buy debt from the government to enable the government to spend. Now, the first thing everybody asks is, won't that cause huge inflation? We'll become Venezuela or Zimbabwe or something like that. Well, here's what the MMT folks say. Their attitude is to ask, why does inflation happen? Well, inflation happens when three things happen. One is that new currency is created. Number two, that currency gets to everyday citizens and they spend it. And number three, that there is a finite limit of goods and services that can be purchased, and we cannot produce anymore. In other words, we're at our capacity. Now, everybody who knows about just the huge numbers of people who are under and unemployed in this economy, who has seen factories close down, we all know that we are not operating at capacity. The MMT people say you will not get inflation until we reach the point where there is simply no more room for us to produce any more goods and services. At that point, people will then begin to bid up the prices of goods and services. But by spending money in the meantime, the government will encourage people to enter the market and to produce those things. We'll have more jobs, we'll have more business activity, etc., etc. We'll close the output gap in a Keynesian way without having to resort to borrowing. Now, what happens if we do get to the output gap? At that point, inflationary pressure arises, and the MMT folks say, at that point, you begin to impose taxation to draw money out of the economy in order to cool it down. So essentially, what the MMT folks are saying is that you can dispense with the entire charade of selling treasuries, going through Wall Street, having the Chinese and the Japanese and others accumulate huge amounts of US debt, and simply spend the money, tax it back out of the economy when we hit inflation in full capacity, when we have employment of something like 2%, and when there are no idle factories, et cetera, et cetera. And at that point, yes, then you can start cooling the economy down. Now, it sounds like a great idea in theory. My personal view of it is that politically, Wall Street and most of the financial and business sector would fight tooth and nail against it. Number one, because it takes Wall Street's role in financing federal deficits out of the equation, and they make a lot of money doing that. And number two, it also suggests that the Federal Reserve really has no role to play. And as we know, the Federal Reserve and the primary banks, the banks all over the country that own the Federal Reserve's regional branches, would find that very difficult to accept. The second question, of course, is whether politicians would ever resort to cutting back spending and increasing taxation to cool down the economy. That's an open question. But right now, the situation that we have is no better. In fact, what we have is a perverse situation where we desperately need stimulus spending, but the people in power, the people who have the ability to say yes or no to these things, mainly in the Senate, are not willing to do it because they adhere to this old idea that we have to pay back our debts. Now, let's go back to the question of inflation. I mentioned that inflation happens not because the money supply increases, but that it increases relative to the capacity of the economy to produce goods and services. So what would happen in a case where we have an inflation, or rather a GDP gap, we have an output gap? Let's take an example. Let's say that steel mills usually operate at 90% capacity. We have a recession, they drop down to 50% capacity, right? Now, what happens? The government launches an infrastructure program. It boosts the demand for steel, for bridges, and for rebar and all kinds of things to build highways and homes and all that sort of thing. And then as the government spending works its way through the economy, that gap is closed. Eventually, the government spending will lead the steel mills and all the other parts of the economy back to full capacity. And at that point, then we will start to get inflation. The government cuts back on its spending. But think of all the things that we would have achieved on the way and how many jobs would have been created, how many people's pockets would have been full of salaries that they can spend, rather than having to scrape by driving Uber and making a little bit of money and living on McDonald's fast food, which is really the case for about 40% of the population right now. So fundamentally, what the MMT people are saying is that we are hamstringing ourselves by insisting that we go through the motions of pretending that the government of the United States has to issue debt to pay for its spending. The point that they're making is that this is not strictly speaking necessary at all. We have the world's reserve currency. It's a fiat currency. We can do with it what we like. We're not like a country like Italy or Greece that is stuck in an arrangement like the euro, where it cannot do this on its own because it doesn't control its currency. Now, obviously, we've been taught over years and years and years to fear the collapse of the dollar as a result of this. Doesn't seem to be anywhere close to happening from what I've seen. I've been hearing people talking about it for 30 to 40 years, and it has yet to happen. Of course, the value of the dollar goes up and down, and it would go up and down in the environment of an MMT policy framework as well. But one of the things that would happen is that the US economy would probably be at near full capacity, booming, lots of people with lots of things to buy. People would be wanting to consume goods, including imported goods, which would be good for the rest of the global economy as well, which would continue to want to obtain dollars to buy things exported from the United States. Americans would want to buy things from other people in the form of imports. So essentially, the only barrier to MMT, according to the people who support it, is the capacity of the economy. And the critical question then becomes, are we at full capacity or not? Now, on that score, I think it is absolutely clear that we're not, and not just because of COVID. Even when we had a very low unemployment rate just prior to the COVID crisis, we also saw historically low labor participation rates. The percentages of adults of working age who were actually working in the economy was at historical lows. All those people who were no longer searching for work, who were sitting at home collecting unemployment checks or disability, or mooching off friends and neighbors, or even in a sense driving Ubers and working in Walmarts that don't pay enough money for basic living standards, those people were dramatically underemployed. Most of those people could have been doing better things. They could have been building infrastructure. I don't know about where you live, but the infrastructure where I live is terrible. We've got potholes, we've got broken bridges, we've got all kinds of things that need to be done. And the only reason we don't do them is because of this notion that we have to fund it through deficit spending and debts. Now, I'm not going to plunk down my flag on one side or the other of the MMT debate, but I will say, and I've been thinking about it very carefully for several years now, I will say that it makes intuitive sense to me. I think that the key question, though, is not whether MMT would work, but how it exposes the fact that the system that we work in, the actual choices that we're forced to make in terms of thinking about monetary policy, thinking about what the government is capable of doing, are essentially designed around a system that is not, strictly speaking, necessary. It's not the only one. And the critical thing is that by starting with QE, we are already moving in the direction of doing it, folks. So if this is a great experiment that we're seeing with QE, and QE is essentially, in a sense, a pretest of MMT. If we get through this without a lot of consumer inflation, if the Federal Reserve, if the government begins to actually take some of the money that it's creating by selling Treasury bonds and spending it into the economy in the form of stimulus spending and infrastructure, then effectively we are going to see a test of MMT. And that would be one of the first biggest scientific tests of a great new potential way of handling monetary economics that any of us will see in our lifetimes. Now, think about the investment opportunities if all of a sudden the government accepted that it wasn't constrained, that it could go ahead and build those bridges, fix those highways, hire people to do all these things, hire contractors to fix all the things that so desperately need to be fixed in this country. If we could do that, we wouldn't need to just rely on $5 trillion FANG stocks to make money in the economy, folks. We'd see stocks left, right, and center booming because the economy would be booming. So there it is for me this week. Yes, it's about MMT. Those of you who guessed correctly, you win a golden cigar, as Groucho used to say. But the key thing is, folks, that this is about opening your mind to alternative possibilities and seeing how the fact that those alternatives are simply pushed to the side and not even considered seriously is part of what holds us back sometimes. That's it for me this week. Remember, the Bauman letter is available to you, and yes, it is a subscription newsletter. I don't say what I say just to get you to buy it. In fact, if I wanted to, I could be a lot more pandering than I am in terms of trying to get you to buy it. I say these things because I really believe them, and I really want to hear your thoughts about it too. So keep those comments coming, even the ones that are absurd. I enjoy seeing them. Again, this is Ted Bauman signing off. I'll talk to you again next week.